Cassidy or Shane. Got it.
Again, thanks for joining us, Cassidy. We greatly appreciate you having you on. Cindy and I
Thanks for having me.
get the opportunity to speak with you on a weekly basis, at the very least, if not more often than that. But of course, we're here to talk about one of my favorite things, which is money. And since we got to know you, Cassidy, you've kind of become our miracle worker when we're finding deals and trying to figure out how can we make this work. I don't know, but Cassidy probably has the answer. So we know all about you, but the rest of the world doesn't, and we're actually going to share you with our group here. So please let everybody know a little bit about who you are and how did you get into this world of money lending.
Yes. Hi, everyone. My name is Cassidy Corrella. I am a mortgage broker. I own my own brokerage, and I have been in the real estate game for a decade, at least at this point. And quick background, my father owned several mortgage companies, so I'm very well versed in financing properties. Although he says he created a monster, and he probably has. So today we're obviously here to talk a little bit about hard money lending, just at a very high level, so we can. It's a difficult process, honestly, but it's not. So hard money lending is a little. It's harder to structure these deals. So one of the things that I do, and the reason they come to me all the time, is you can absolutely get into a deal, a fix and flip, a fix and hold, with zero money of your own. Like, that is a true statement when we say that. However, doing that and getting the deal structured in a way that the lender will lend on it is what is complicated and requires a lot of innovation, let's say. So when we talk about hard money, we all think of, some doctor down the street who gives out $300,000 for a quick fix and flip. Now, yes, that is hard money, but it is also a much smaller version of a larger pie. Hard money lending, I like to refer to as asset-based lending. Okay, so we're lending the money based on the asset. Then you have private money lending, PML and HML. And when you put those two together, that's when you can get into a property without your own funds.
That's where the magic happens.
That's where the magic happens. And that's when you can, just spend your time finding the property and underwriting the property with Shane's help. And I'm there to help you structure the deal in a way that you can accomplish this task. Let's go back to hard money being asset-based. So most of these hard money lenders that are a larger scale size, not just your mom and pop shop, are going to require an appraisal on the property because they're underwriting that property themselves. And then the private money lender, they're underwriting your pro forma, right? They're not underwriting the actual appraisal. They're not requiring an appraisal. They're two different beasts and they're different in nature. If you go to a larger asset-based hard money lender, your interest rate is also going to be much lower than if you were going full primary or private money lending, and your origination will also be typically lower. Origination on these loans is around 2 to 4 points, depending on the lender. And there are multiple hard money lenders out there, as you know, that operate on a larger scale than just picking up the phone and dialing for dollars kind of hard money. The one thing that they're all going to look at, if you're trying to do these deals with 100% financing, remember, that's what we're looking to get. That's the end game, is a good credit score, because a lot of these will pull credit, the asset-based side. And also, you'll want a legal entity, and you'll make sure to have your operating agreement, your entity docs, your state articles of organization in place when you start these. Then on the private money side, you will get a second loan. Now, some of the hard money lenders will allow for that private money to be in second lien position, and others will not. So that is another facet of this that can become more complicated. It's finding out where to take the loan, what hard money lender is going to accept that loan. Another thing is going to be your experience level. Now, your experience level dictates a lot.
On that note, Cassidy, you don't really know which hard money lenders we as investors don't know which hard money lenders are going to allow a second lien position or not.
Correct.
So your strategy going into it, you must let Cassidy know in advance because she can steer you to the correct
Yes,
money lender.
yes. So I like to have initial calls with people so we can discuss whether or not you're gonna need a personal guarantor on the app. For instance, if you have no experience, I have to structure the loan a little differently. So there are many facets that go into me structuring the loan and finding the right hard money lender to do the deal. And that's gonna require a little bit of finessing and figuring out just who is going to be your PML in the beginning at the outset, because that will dictate how we structure it and what hard money lender we're going to go to. If you have, let's say, some credit issues and you're at like a 660, some lenders will accept that on the asset-based lending side. So, you know, there's a lot of room in there. Some hard money lenders will allow for a non-app personal guarantor with a better credit score than yours. And we can play around with the operating agreement of the LLC in order to do that. So there's many solutions to do this, and you have to get very creative in order to do so. But it's important that you structure the deal right from the beginning so that you're not wasting time with the wrong lender.
So Cassidy, in your bag of magic tricks, do you just do single family homes?
No, I do not just do single family homes. I do multifamily, commercial, hotels, all kinds of things. When you start talking about larger scale commercial, you're going to need more of your own skin in the game. But multifamily, we can still work on the 100% financing role. We can do, in that bag of tricks, I do double closes often. So there's a lot of different creative ways to structure the gap funding. If you have, let's say, a seller held carry, right? We can use the seller carry as a second lien with one of the hard money lenders that allows for second lien position. Or we can do the double close where you have someone come in as a PML just borrowing their money for a few days to show the amount of funds that second lien will be. And then they'll take that money right back and the seller carry will come in behind the scenes. So there's many facets and strategies to this, but it's not just single family homes. It is not manufactured homes though. So none of that.
So when you think about a creative deal, you know, as Cassie was just giving you some examples, she has that mindset of how are we going to get this done? And it's not always, you know, if you want to get from point A to point C, it's not always A, B to C. Sometimes there's 5 or 6 different paths to take in there. And
Correct. There are many different avenues to take, and it's up to me to determine which avenue is going to be the best. And also within that scope, it's not just about which lender will do it, it's about which lender is going to do it at the right loan to cost and the right interest rate that's going to make your deal pencil. So just because I have, let's say, maybe 4 lenders that will do your deal specifics, the structure, one of them is going to be possibly better with points and the other may be better with rate. That will dictate more, because if you have less liquid to bring to the game or you're borrowing all of that money, we're going to want to go with the higher rate and the lower points because you're paying money on the private money. So we're going to want to do less origination, higher interest rate in that case. And that's another facet of structuring it so that it's the best deal for you, the borrower. And we'll work in conjunction throughout the course of the loan. We'll talk many times. You'll get tired of hearing my voice, but you won't have to see my face much. I don't do this camera thing. So
you're a natural, so you should.
I get nervous on camera. So you'll talk to me many times and we'll go through the whole process, and you'll learn throughout the course of this how this actually works. Like, I teach my clients. I don't want you flying blind. By the end of your first one, you'll understand. And the next one we do, you'll be like, okay, this is what I have. This is what I did, and you'll know what to give me, what information. I won't have to like glean it from you, which typically I will end up having to ask questions that you don't even know to ask because you won't at this point, you know. And there's other factors that come into play, like personal guarantors. Adding a personal guarantor to a loan will give you experience that you maybe don't have, which can give you a higher loan to cost. I'm doing a loan right now that's a fix and flip, and it's a luxury fix and flip with what we call heavy rehab, which is over $300,000 for this lender. And every lender has a different definition of what heavy rehab is as well. Some of them have a monetary amount placed on it, and some of them decide based on, well, is there square footage, is there structural changes? So it's called an overlay when you talk about the hard money lender. So I'm doing that deal, and the borrower is bringing $5,000 to the table, and it's a $1.1 million purchase with $300,000 renovation, and that closes next week, and they only have $15,000 in this deal, keep in mind, and they have no experience. So in order to get that done, I reached very deep into my bag of tricks. But it is doable, and that's the important thing. And we'll discuss all of that when we discuss your deal structure and what things you have that may hinder you versus what things you have that are a benefit to us in the loan process.
That's awesome.
So
That's why we're sending everyone to Cassidy.
Not just my pleasant demeanor.
Well, that too, my friend. Listen, I just got off a call with Cassidy earlier, probably 30 minutes ago. I said, I have a problem. Of course, Cassidy solves it, or at least tries to, right?
Yes.
Oh.
Yes, I will do everything in my power to. I'm very solution driven, and I'm very creative, so I'll find a way to get it done. I was telling them I was working on a deal. This is a true story. And the borrower was represented by a realtor on the buy side, and the realtor had negotiated for my borrower, my client, to pay all of the real estate fees on both sides. And I was like, this is not going to fly because now the numbers don't work. We're in a liquidity crunch. So I actually found the seller on OnlyFans and signed up on her OnlyFans to private message her to be able to talk to her directly.
Yes.
Shane and Cindy know this story, and Cindy was like,
Yes.
you're crazy.
Yes.
But I got a hold of her nonetheless and was able to restructure the deal. So
Yes. She goes to, by all
I stop at
means.
nothing.
She was stalking somebody on OnlyFans.
That's
Yeah,
funny.
she actually appreciated it. She was like, I can't believe this. She got a better
Crazy.
purchase price, and it all's well
Yeah.
it ends well.
Yeah, it was good. It was good. Awesome.
So Cassidy, at what point in the process should an investor be reaching out to you to go over what's required to close on a deal? Should they wait until
Before you've identified a property,
Yeah.
you want to start ahead of time. You want to have spoken to me to know where your limitations are and what to be looking for, because there are certain limitations, like I said, that each of you have, but there's also strengths that you'll have that you may not know of. So the first phone call is starting with me. Then you'll know what you're looking for in your deal and how to structure it and what these rates look like, what the origination fees look like, because they're all different. And you'll know what you can afford to pay in interest to your PML money in addition to your HML. Because remember, these are two loans running in conjunction with each other. And I always try to remind people that you are paying the loans also. So like, that's something to be aware of. Is we can also structure so that some of the money to pay the loans can be in the rehab funds too. That's a whole other ball game in the bag of tricks, and we won't touch on that today because this is, not enough time for that. But so there's, again, you want to start out speaking to me so that you know what to look for going forward. After you speak to me, you'll understand the process and who you need to get involved in this process. Because if you do need a personal guarantor, you need to be thinking about who that might be and who'd be willing to do that. If you need a JV, if you need a PML, you're going to need to have all that set up ahead of time, because when we're doing these deals, they're really cash transactions. So you're not going to have this like 30-day closing window and then your escrow money will be at risk. So you really have to start with the deal structured right up front and everything kind of in place. Then you go to Shane, and Shane will underwrite it once you've identified a property, and he can underwrite it based on the actual numbers that we've already discussed on the lender that I know I can fit you with. So then he can have an actual real tangible numbers built in, because I know what loan to cost we're going to be able to get, because your loan to cost is based on your experience, and each lender has different loan to cost parameters based on that experience. Some lenders will go all the way back to the past for experience. Some will only go the last 36 months. So again, that's another like overlay that's very important for me to know. And these are questions that I have to ask you when we're discussing how to structure this. So I know, okay, we have Jenny up there in the corner. Okay, Jenny has no experience, but she's got great liquidity. So this is where we're going to take her. And then when you find a property and you go to Shane for it to be underwritten, I'll have concrete numbers for you based on the lender that's going to be best suited to you and your specific deal. Now, these deals will change, and the lender that's best suited for you will change with each loan as well, because if it's based on experience and you've already done your first one, then guess what you have? Experience. So then we have more doors open to us. So each one will change, and the way we structure each one will change as well.
So in that, adding this in, but I know you said it, but in a different way. So if Stephanie wants to go out and buy a rehab home, but she hasn't done one before, and really to get the best rates, the best chance of approvals, they're looking for somebody that has some experience.
Yes. Now, it's
Could
not
they go-
necessary.
Yes,
Sorry,
it depends on the loan package, and probably new construction is probably even more stringent in that area, correct?
Correct. Correct.
But
So-
then she could go out, she could partner with somebody like Jenny or Lorraine and just say, hey, I know you have the experience. I have the deal. You want a JV on this, and bring those two pieces together. And that way, Stephanie has a better chance of closing on this. And now she's got the experience, right?
Correct. So you could do that. We've also done, I've done times where people have joint ventured or non-app PG'd for reserve funds too, because that's another thing that you're going to need to show with some of these lenders is reserves, meaning 6 months for some. That's just the general standard. I have one hard money lender who only needs 1 month of reserves, meaning the amount of money to pay the loan. So PITIA for 1 month to 6 months in the reserve funds, and the reserve funds will decrease as your experience goes up as well. So again, that's understanding which lenders do what and will allow what. And then, we fit the pieces together based on that. And I've had non-applicant personal guarantors that don't JV that are just paid a fee. So there's a lot of different ways that you can go about this.
That's a very neat point, because a lot of these deals we talk about on the creative side, none of your own money out of your pocket to close on them. That doesn't mean you don't have any money. Sometimes you have to have money staked, right? You have to be able to show money in the bank account in order to qualify for the loan, even though you didn't bring any money to the table. So
correct. So just because we say no money, that means no money out of your pocket, but there has to be money somewhere. We're not getting in them for free. And we do have to show certain things to create what it's called risk layering. So we want to reduce the layers of risk, and we do that by adding reserve funds, experience, etc. So when you're brand new and you don't have these things, we have to bring in other factors and facets and perhaps people or entities in order to compensate for those layers of risk.
I see that Richard has a question here. Says he needs a review of his hard money lender and private money lender exit home refi. How do people schedule some time with you, Cassidy, to go over upcoming deals or deals that they're working on? How would you like to do that?
So I have a Calendly link that I usually send out, and you can get on my schedule, which is probably much like Shane and Cindy's, which is hectic. And you can speak to me through there. There's two different versions. There's a 45-minute and an hour long, and the 45-minute is like your intro to all of this world of hard money, PML, and all of these things. That 45-minute call is the one that is going to teach you the ins and outs, the basics, and allow me to know which direction I should be going with you. And the second call will be a longer call. That's an hour. And that's once you've actually identified a property and you need to underwrite it and all of that. So like you'll go on that hour-long call, and that's when we'll actually figure out all the documents, the needs list, everything that you'll need for that particular property, and what the actual interest rate is going to be for that property, what options you have for it. Because again, remember, each one of these hard money lenders has different overlays. So if you come to me with a 2-unit versus a 1-unit, I may say, hey, that lender that I thought I was going to put you with, we're not going to go with them anymore because they have a higher interest rate for 2 units versus 1. So then the second call is actually structuring your specific deal once the property has been identified and under contract. So you can do that pre or post contract, as long as you've done the 45-minute call and we know for sure that you have everything you need in line, then you can get under contract anyhow. You just have to ask me for a approval letter. Send you one.
And I know the question comes up quite often is if somebody needs a proof of funds letter, what's the best way to accomplish that?
So it depends on who it is that is selling the house, but there are times when I send an approval letter, basically just saying that you have a hard money loan approval, and that will get accepted in lieu of the proof of funds. If not, if they're asking for a real proof of funds, more often than not, they know that they're selling the property under value, or it's a wholesaler who also knows that this is really not cash, that it's actually a hard money loan. So in those cases, they'll typically accept me sending a hard money letter, like saying, hey, LLC XYZ LLC is approved for this amount of hard money loan and such date of closing. And they will allow for that. Not in all cases, especially if it's somebody that really just only wants an actual cash buyer, that's like, here's the money. But then you're going to lose that deal anyway, because you don't have the proof of funds and they're not accepting it. So no one with a fix and flip loan is getting that property.
Yep. And again, when it comes back to that asset qualifying, if it's not going to qualify for the program that you have, it's probably not going to qualify for anybody's, right? The same
Correct.
real estate investors are having that issue with that property. Yeah.
Yes. So if they're not willing to accept the approval of the hard money loan, then no investor is getting it unless that investor really has cash.
Right.
So it won't go to a new investor who's using hard money. It would actually go to a real cash buyer with a sizable bank account, which we all hope to have.
Well, I'll stop asking questions. I could talk with Cassidy for hours. Does anybody have a question for Cassidy, or Cassidy, is there anything that you want everybody to know about you or the process? This is kind of like your introduction call. And Richard
Yes,
has
I think that Shane's going to post the Calendly link in the Facebook group. I'm pretty sure. I'm not sure the best on that.
I didn't post it. I wanted your permission first, so if that's okay with you.
Yeah, of course.
Yeah.
I'm going to, I think Richard has his hand raised.
Yes. So, what I was talking about on the hard money and private money lending is, so I have a deal that closes next Friday, and I have a purchase price for the hard money loan for $364 at 11.95%. And then for the private money, it's going to be 20% of ROI once I refi. What would be the best way to go about that?
So you're to refi out of the investment property into a longer term loan?
Yes.
Okay, in that case, we would be looking at a non-hard money loan. That would be more of a long-term debt service coverage ratio loan. In which case you would either have to have a tenant in place that has a lease agreement for 1 year, as well as 1 month of rent deposited and security deposited, or the additional method of getting a 1007 appraisal. So you'd have the 1004, which is a single family home, plus a 1007, which is a fair market rental evaluation. They would tell you how much the property is going to rent for. If that amount covers your PITIA, your principal, your interest, your taxes, your insurance, and association dues, then you will qualify for the loan based on the income of the property. When we're talking about this debt service coverage ratio loans, we're again underwriting the property, not the person. With the caveat of you still need a good credit score for debt service. Those are long-term, 30-year fixed, fully amortized loans. They also have origination fees. Any investment loan has origination fees, just the nuts and bolts of the game. There are a lot of DSCR lenders out there, and those are a more regulated type of loan. So they will ask for more documentation, proof of insurance. I mean, all of them are going to ask for proof of insurance, but like it's more heavily underwritten in the DSCR because you're thinking, so it's a 30-year loan, it's a fixed rate loan, and there is some regulation involved in it, unlike with hard money where there is no governmental oversight. But that would be what you need to do is start a DSCR loan for that property.
So Cassie, did you say they has to season for a year, or they have to have a lease that is for at least a 1-year term?
So they have to have a lease for 1 year written. It doesn't have to be in place for 1 year. The other thing with debt service coverage ratio loans is a lot of lenders with DSCRs require 6 months of seasoning to go off the appraised value. I do have one lender that will go off of 1 day seasoning for appraised value. So if you have you've got a distressed property that was well undervalued and you had to buy cash with a hard money loan, and then you have that high hard money interest rate, we can refi you immediately into a long-term loan with a much, much lower rate. You're talking from 11 and 12%, sometimes 13, depending on your hard money lender, to something more like 7 or 8, which is a huge value. And then in addition to it being a lower interest rate, you also have the fact that you are in a 30-year loan. There is no balloon. You're not at risk of losing your asset for 30 years. Further, it's not interest only, it's a fully amortized loan, so you are paying on principal. In addition, if you manage to get one of these properties under value and you go with the appraised value, you're actually pulling cash out because they're going off the appraised value and you got it under value. And we can go up to 75% of the value of the appraisal. I think someone else is raising their hand.
Shane, you're on mute. You're on mute, Shane.
So that's really where some of that fun stuff comes in, right? So if you got the property at a really nice price, and some
Yes.
rehab work or whatever you had to do to it, then the appraisal value comes in up here. Now we're talking about some free money, right? So this is cash
Yes.
that you can pull out of your deal. It's not income, it's cash you can use to roll into your next deal or whatever
Correct.
your strategy is. Yeah.
That's the ideal scenario.
Yeah, that's the ideal scenario. Wait, that can be a positive number. It's not always negative.
I have a $2.5 million ARV in Naples right now that the guy's pulling a ton of money out of.
Oh, nice.
But yeah.
Jelly. I'm jelly. Looks like Jacqueline has a question.
Hi, Jacqueline.
So I just want to find out, I think you mentioned, but maybe I missed it. So when it comes to the personal guarantor, am I the one coming up with the personal guarantor, or it's something that it's possible to get one?
I'm sorry,
Hello?
can you say that one more time?
Did you hear what I asked? I said when it comes to the personal guarantor, am I the one who is meant to come up with the personal guarantor, or is it someone that it's possible
So
to
there's
get?
2 ways. You can find someone that's willing to do it. That's either a friend or a family member or a colleague, or I do have personal guarantor services, but that will cost money,
Okay. Good to
like
know.
everything else.
Thank you.
Mhm.
Okay.
So yeah, so the Cassie's point, it's your deal. So if that's what's required to bring to the table, as you bringing a personal guarantee, first and foremost, that's on you. If you can't do that, and you say, "Hey, I need help there," let Cassie
Correct.
know. She has options. We have options. We can help you, but those are additional fees.
Like
Those
everything
people are now
else.
part of the risk, right?
You have that
Yes,
initial
exactly.
conversation. Yeah, you need to be upfront about everything, like what you need. Did you underwrite it? You know, you have to let Cassidy know everything.
Do not lie. Tell me
Yeah.
the truth. All of the ugly nuts and bolts, like,
Yeah.
if there's bad credit, that doesn't mean we can't do a loan. You know what I mean? I just have to know all facets of what we're dealing with, so I know exactly how to attack it. And that's very important. So there's always a solution. There's always a way to fix the problem. I just need to know that the problems exist and they don't get sprung on me.
Yes. Yes, I would agree. You're great. Does anyone else have any other questions?
So back on my property, so I am walking in on almost 600K in equity.
Okay.
And when you said that scenario, that's why I was kind of questioning, because I'm like, I know it's gonna be like a lot that I'm owing them, at the end. So I was like, what's the best scenario in getting out, knowing that I'm in equity going in?
You're in an equity position, then you'll be fine as long as you know that it does debt service. If it doesn't, then that's when we have to talk about, you know, getting a lease in place
Okay.
that is larger than that PITI.
Okay.
What is your income strategy on this property, Richard?
So this was the personal home one that I was telling you about. That was a 5-bed, 4 baths, 4,000 square feet. The homeowner renovated it last year, but he could not make the payments. They were trying to do sub 2, but I thought it would be reasonable since it had like almost 600K in equity to just take it on as a home. So I was using hard money and private money. Most of the private money is land money that I put into the land that I was telling y'all about a while back. They're just giving it back to me. And then once I refi, I could put it back into that land deal that I had.
So yeah, so at this point, you bought a property that's got a good chunk of equity, but you don't have a cash flow strategy for it, right? You're not planning on it being a rental, a short-term rental, anything like that. Yeah, is that correct?
Correct. I have to talk to my wife because, like I said, it has rental potential because the garage is fully renovated for
There's
somebody
a
to live
solution
into.
here, but this is a private call solution.
Okay. Yeah.
So call me later, Richard. I have a meeting at 6, but after this video, I'll be free.
Yeah.
Okay.
And I will post Cassie's Calendarly link in the Facebook group. And we'll pin it there so people can find it. And let's go reach out to Cassidy, get an understanding of where your finances are, what's doable, and let's go find some deals.
Sounds good.
Yeah.
Any more questions before I let you guys get to your Friday night?
I think,
Ca-
yeah, they
Cassidy,
can,
I know. Sorry, go
go
ahead,
ahead,
Cindy.
Shane. No, go ahead, go ahead.
Cassidy, we greatly appreciate you coming on. I know you don't do the video thing very often, so we do appreciate it. Thank you, and hopefully we look forward to seeing you again. And
Thank you for having me. I hope everyone has a wonderful weekend, and I hope this was at least a mild level of understanding. It's a lot to really take in, and it takes some time to understand every facet of it. So don't feel lost because you should be right now.
we're gonna see if we can't come back in the future and have some specific discussions around each different type of strategy. Maybe we'll just have a discussion around DSCRs or
Yeah.
around fix and flips or around new constructions, and just kind of keep them short and brief and to the point. And we'll tackle them one at a time.
Sounds good.
Thank you, everyone.
Bye, everyone.
Guys.
Bye.
See ya.